Thanks for joining today, and for those watching the recording, my name is Michael Donoghue, Head of Business Development here at ListedReserve. Looks like we've got plenty of people in, everyone's on time, so let's just get into it. We're going to keep the webinar to 20 minutes today, so we've got plenty of time for Q&A afterwards. Just to ask a question, there's a little box in the bottom right-hand corner of your screen there, questions. Just type them in at any point and we'll get to them at the end. It's only going to show your first name, so you don't have to worry about getting doxed. And of course, a quick disclaimer before we get into it. Just remember this webinar is intended to provide general information only. It doesn't take into account your personal circumstances, so please consult a financial advisor before you decide to invest or not. And with that out of the way, I'm going to turn my camera off, hand it over to Dan, ListedReserve Chief Investment Officer. Dan?
Thank you, Michael. Morning, everyone. We'll aim this morning to give you an overview of digital assets, but perhaps more specifically, what the tailwinds are behind the asset class. So in particular, I want to touch on demographics, which I think are one of the major tailwinds here and that we're going to see over the next decade. Many of you will be familiar with the millennial generation coming of age. By 2030, that cohort will be the highest share of disposable income of all generations. But more importantly than that, $30 trillion of assets are going to transfer to that generation from their predecessors. Mostly that's composed of bonds, equity and real estate. But this cohort is 6 times more likely to buy digital assets than their predecessors. And we see that ratio as something that's going to grow over time. And so if you think of someone now that holds $100 in bonds that will look to sell in retirement, you've got to ask yourself the question, the cohort behind them, which is smaller, who's going to buy that bond, given that their preference for asset allocation is different than current generations. So I think the outlook for traditional assets looks rather different going forward and looks rather better for digital assets. And one of the reasons that we're seeing this shift is that younger generations, for them, saving in fiat currency, it hasn't worked. And it hasn't worked for a variety of reasons, which we'll touch on. And I think one of the major reasons is since 2008, the actions of central banks and the expansion of the monetary base that we've seen. So if you look in the Western world, the money supply in general doubles every 6 years. So if you're young and a saver saving for a property or something, asset prices have got away from you faster than you can save in the monetary base in which you earn money. And so faith in that currency is failing amongst younger generations, that they don't have the same faith in institutions that their predecessors had, and because they haven't been able to get ahead by saving in fiat. And so they've shown a strong preference for digital assets. And we think that that will continue. We think it's a huge tailwind, particularly as their dominance of earnings, income, and overall control of assets grows over the next few decades. And that generation's had a particularly good instruction in scarce assets over the last 10 years, which is why they have much more belief in digital assets than perhaps predecessor generations do. When we look at the asset class as a fund, we segment it, and I've provided a sort of frame of reference here for you as simply as I can. There's lots of talk about this sector, but as simply as we can explain it, we have here. And I'll talk about each one of these segments and the opportunities that we see in each of them later. But the way we view it is store of value first. So Bitcoin, the first asset in this class, its sole promise really is verifiable scarcity. Everyone around the world at every time can agree on how many of these are in circulation and how many there will ultimately be. And that's it. It's as simple as that. It's actually a profound discovery and a profound invention that was one of the major problems in computer science for a long time, this idea of how do you get a decentralized consensus. But there it is. I think it's a very simple promise, which it's honored and continues to deliver on. DeFi is decentralized finance. We consider DeFi as financial services which are provided by software. So what you might traditionally get from a bank or an insurance company, you will get from a piece of software that runs the program. And finally, Web3, the definition of which I think is still up for grabs, but we think of it as owning digital assets. And by digital assets, I mean it could be data, it could be art, it could be inside video games, it could be fashion accessories inside a metaverse or a digital world. And so, for example, at the moment, Facebook own your data on Facebook and they monetize it. In a Web3 world, you would own your data and you would monetize it. That's the difference. Two opportunities. The first one, Bitcoin. Interestingly, the main feedback we get here from investors is I feel like I've missed the boat. And I think that's profoundly wrong. And the reason I think it's wrong is most of the money that will ultimately come to Bitcoin is still on the sidelines. So if you look at the penetration of superannuation funds in any country around the world, it's basically zero. But that's starting to change. So we've seen recently Fidelity in the US, which provides over 21,000 different 401k funds for Americans. They've got 2 million clients investing through those funds. They're going to allow Bitcoin as an asset class. And interesting, they're going to allow people to put up to 20% of that fund in Bitcoin. Now that seems rather high to me, but still it's a tremendous amount of potential money that's going to flow into Bitcoin. I think we'll see something similar this year in Australia when we get an ETF. I think that will be quite a popular product for self-managed funds. Ultimately, we will get a US spot ETF. At the moment, of course, we only have the futures. And when we get that spot ETF, the US product will undoubtedly be the largest and have many billions in it. Outside of these regulated products, we see nation states adopting Bitcoin as currency, small ones, it must be said. So El Salvador, Central African Republic, and then some autonomous regions around the world, like Lugano in Switzerland has now adopted Bitcoin. You can pay your taxes there in Bitcoin. And similarly, Madeira and other locations around the world. So slowly the dominoes are sort of starting to fall as far as nation states are concerned. But the key thing is that the major money pools around the world just aren't invested in Bitcoin yet. It's all been fringe investments at the sort of edge of people's investment portfolios. It's not mainstream yet. And when it is, I think we'll see a significant difference in activity. And most importantly, 90% of the Bitcoins have already been issued, right? So all of this money that's not here yet competes for that final 10%. And there's a profound difference between this asset and nearly all others. And that is that supply cannot change to react to demand. The supply curve is fixed. So even with gold, when the gold price goes up, unprofitable gold mines suddenly become profitable and the supply starts to respond. Only a little bit. But still, this cannot happen with Bitcoin. There's only one vector that can respond to demand, and that's price. So we expect when this money on the sidelines in super and 401ks in particular starts to move this way, it should have an impact. In decentralized finance, we like very much the digital asset exchanges. They are essentially the picks and shovels of this whole sector. So when something new happens, as with last year with NFTs, they sell them and they profit from them without having to take the sort of risk of the individual NFT. The best performing asset in our fund over the 5 years has been Binance's token, which has performed tremendously well. And I think there's a long way to go for these particular businesses. I think they're highly investable, they're highly profitable. And if you look at the NASDAQ versus Binance, so the NASDAQ does 5 times the volume that Binance does on a daily basis, keeping in mind Binance trades 24/7 and the NASDAQ is just a 5-day thing. But still, it's 5 times the volume on the NASDAQ. Profitability is entirely the reverse. Binance is 5 times as profitable as the NASDAQ. They're highly investable assets as far as we're concerned, and we like being in them because they benefit from the whole ecosystem without us having to necessarily take specific risk. Web3, This is relatively new, and I would pose these questions to you when you're thinking about Web3. Will people buy what I consider digital trinkets? And I think we know the answer, because inside video games, people spend $300 billion a year on assets in video games. The difference is they don't actually own them and they can't resell them. And that's really the promise of Web3, is that you will own it and you can resell it. We see a huge market for that, particularly in video games. Then, is digital art worth money? So I'm talking about NFTs here. And on the right-hand side of the page, you'll see some NFTs, possibly the most famous, the Bored Apes. Each image here is worth $500,000 Australian dollars. And you might think, the originals, of course, you might think that's ridiculous, but that's the reality of the market. These assets are now used as collateral for loans, and there's quite a big market in them. They're tremendously popular, mostly because of their scarcity and first mover advantage. But it's a real market. Digital luxury goods, we see a lot of the brands. So, are we going to get Prada handbags inside metaverses? Yes, we absolutely are. Are those brands all working on it? Yes, they are. And I think it will be real, particularly in social media, and people happily display their digital luxury goods and spend money on them. And land as well. And there's been a few releases of digital land this week, one of which raised $350 million US. There's a real market for it as these metaverse ecosystems build out. It's kind of like the land grab in early America at the moment. So there's a lot of money flowing into that. So premium digital real estate is going to go for pretty good prices. We think of Web3 by investing in the protocol layer. So we don't buy NFTs, but we certainly are interested in the platforms that they run on. So in this case, for the apes, Ethereum, and there are other platforms that NFTs run on, and other metaverse platforms that we're also interested in. But we're at the layer that the asset runs on, rather than the asset themselves. Again, because we don't want to take the specific risk of an individual NFT. Risks in this sector. So risks in this sector are real, and I'll talk a little bit more about them as they relate to our fund at the end. But drawdowns are common. So we're in the middle of one now, a 40% drawdown. Everyone that comes into our fund, I say to them, be ready for a 40% drawdown at least at some point on the journey. And you should steel yourself for volatility and just make sure you're comfortable with it before you engage. I'll get to that more at the end. As to risks, for us, we're an active long fund. The most important thing is custody. Looking after assets is crucial. You've got to make sure that the custody is right, that the assets are safe. And we use a top tier custodian that we're really pleased with. They've been terrific. We're extremely comfortable with how we're doing it, but that's the most important thing for all investors, that the assets are safe. Protocol risk is the risk that something's wrong with the code. So it gets hacked, you lose all your money, it goes to zero. I think with the older assets like Bitcoin, we know that the protocol is pretty robust. People have been attacking Bitcoin for 13 years now without success. So I'm very, very confident in the older assets. I think the newer the asset, the greater the protocol risk. So be careful with new things. Active long short funds, again, a reasonable strategy, but introduces counterparty risk. We saw in May 2020, a lot of the long short funds had real difficulty. Some of them went bust because they couldn't execute in a highly volatile market. So when COVID hit and everything went down overnight, most of the exchanges went down because of the volume of activity and they couldn't cope. And so those funds weren't actually able to execute at the most critical moments. So worth keeping that in mind. DeFi and staking. So just to explain this, if you hold a stable coin, for example, a USD stable coin, you can post that into a DeFi protocol and it will pay you interest, and you can collect the interest, but you're reliant on the contract that does that. So the software contract, if there's anything wrong with it and it gets hacked, you can lose your assets. Now we see one of these a month at the moment, and large ones. So we don't engage with this particular sector at all for that reason. It's not to say that there isn't something there. There certainly is. It's just new and working itself out. I consider it quite risky. And finally, trading. So all of the above, and then the strategy risk of trading. So lots of people are making lots of money trading in this asset class, but there's even more people losing money. And the reason for that, I think, is that actually the trading is really only 5 years old. And so everything that happens in this sector is new and it hasn't been seen before. And so it's very difficult to trade in that environment. That's not to say people aren't doing it successfully, but it is, I consider it the highest risk of all potential strategies. Considering all those risks, that's why we're down active long only. So some considerations for you about how you might invest and what you should think about. And here are the ways to do it. First of all, DIY. So this is you opening an exchange account, buying some assets and storing them on hardware wallets. I think a great way to learn, but for amounts more than $10,000, unless you understand what you're doing and you're technically skillful, I would suggest be very careful. There's some things to consider as well. Estate planning. So if you were doing it with significant sums, you need to make sure that your ancestors can actually access these assets and that you've got a backup plan if anything happens to you. If you leave the assets on the exchange, you've got the risk of loss if anything happens to the exchange. And the number one way that people lose digital assets is through self-custody and not really understanding what they're doing, or then using the assets and sending them to the wrong place and not being able to recover them. DIY, I say, great to learn, but small amounts only unless you really know what you're doing. Next up is the passive funds, the ETFs. I think we'll get a Bitcoin ETF in Australia very shortly. And shortly, I mean, if not this week, next week. Single asset regulated. You know that custody's been sorted. You know it's a regulated structure. You'll be able to access it through your brokerage account. Good product, safe product, single asset only. And I think the difference really between that and active funds, which is us on the right-hand side, we're spread across a number of assets. And the number one difference is that we get early access to new assets. It's taken 13 years to get a Bitcoin ETF, during which time there have been tremendous gains, which people haven't really had access to. And that's really the promise of the active funds like ours, is that we're in those assets earlier, and you know, we can work out what's good and what isn't, and that's really what we're doing for investors. Specifically on our fund, so it's an active long fund, no derivatives, no leverage, and we take as little risk as we can. As you can see, we've returned sort of 5.6 times over the journey, but I would draw your attention more specifically to drawdowns again. So our worst month, we were down 38%. That was November 2018. We've had 4 drawdowns of around 40%, one of which we're in right now. I expect this to continue. I want to call out this volatility to potential investors. Just be aware of it. The timeline we talk about for people is 3 to 5 years. And if you're in for that long, then I think you're going to worry about the volatility less. There will come a time when there isn't this volatility in this sector, but I think that will also coincide with lower returns for the long term. So when that money comes in that I talked about earlier, I think volatility is going to start to bed down when pension funds are invested. But there's a reasonable argument for being in before that happens. But yeah, please be aware of those drawdowns. And our fund is wholesale only and daily price, so you can come and go as you please. But just keep in mind the risk. And that concludes the specifics. So I think we'll move to questions if we can. I can see I've heard them sort of popping up in the background. So Michael, do you want to administer, and I'll do my best with the questions?
Yeah, sure. We've got a few that have come through. Keep asking away as well, guys. We've got a few as well that have come during the week from people who plan on watching the recording. But first, I think a good one here I saw at the start. What are the numbers behind you, Daniel?
Oh, yeah. Yeah, this is actually the Bitcoin Genesis block. So it's the first ever Bitcoin block. It's quite a famous sort of piece of code. Embedded in it, the guy Satoshi Nakamoto, who was behind Bitcoin, put this message about the chancellor on the brink of the second bailout, which was back in 2019 after the sort of 2008 bailouts. So There's a very famous message embedded in the first Bitcoin block. You can still leave messages in the Bitcoin blocks. I mean, I occasionally leave them for my kids on their birthday, so you can still post messages in there. But that's what he did right at the very start. So yeah, a famous image in this sector.
Very good. One that came through during the week from Tim. What are the risks this sector could go to virtually zero? It seems adoption is accelerating, but what are the existential risks remaining?
Yeah, so the go to zero question, I think, is still relevant, and we do get asked it a lot. I think with the major assets in the class, so if we look at Bitcoin, the risk of Bitcoin now going to zero, I think, is very low. And two things have happened in the past sort of 2 years that make me feel that way. First of all, the regulated vehicles that are able to access Bitcoin. So you've got your Bitcoin futures ETFs in America. You've got ETFs in Europe, ETFs very shortly in Australia. You know, it's inside regulated products. It's not quite mainstream, but it's talked about every day. So that's the first thing. Those regulated wrappers give me tremendous confidence that we're not going to face regulatory warfare when it comes to Bitcoin. The second thing is Bitcoin mining. One of the ways to attack Bitcoin is to take out the mining. And we saw an attempt at that from China last year. China hosted sort of 60% of all Bitcoin mining at this point last year. And in May 2021, they closed it all down. And that precipitated one of the 40% drops I talked about. And I guessed at that time it would take at least 12 months to recover that mining hash. As it turned out, it took 6 months. It was one of the great engineering moments in the history of the world, this reallocation of mining equipment. But in 6 months, the hash rate was back to where it was before. And I think that sort of nation-state attack on Bitcoin, it passed, for me, the final test that I'd worried about. So that's the sort of major asset in the class. And as we move down the market cap curve, I get more and more nervous about that things are going to go to zero. So if you look at the whole category, say there's 20,000 digital assets now, 98% of them are going to zero, right? It is a relevant question. And I think you've got to look at the fundamentals of the asset. Is there a business model really? What does it actually do? Does it do what it promises to do? All questions that we ask actually when we're assessing assets for the fund. So I think it's a very relevant risk, a very reasonable question. Most of the assets are in fact going to zero, and it's about picking winners. And it's a bit like the internet era, right? There was loads of stuff at the start of the internet era. Most of it was nonsense. Some of it obviously now dominates the whole world. I expect the same to happen here.
Great. We've got a question from Robert here, the most upvoted question so far. What do rising interest rates mean for Bitcoin and digital assets in general? Very topical.
Yeah, I think rising interest rates, they're not good short term for any asset class, right? And I don't think, you know, we're not going to be able to circumvent that. The thing with rising interest rates, though, they back up our economic thesis. They're rising because inflation's rising, and inflation's rising because so much money's been pumped into the system over the last 10 years. And that is the entire thesis behind our fund buying assets that are scarce. I feel extremely well protected from that inflationary dynamic in the fund. And the fact that the interest rates responding and causing short-term disruption to price, well, we sort of expected that. But when I look long-term, you know, the macro thesis that we follow is playing out really beautifully, and it has done for 5 years since we launched the fund. I think, you know, there's going to be no slowdown in the production of fiat currency. We might get a pause this year. Let's see what happens when quantitative tightening starts in June. I think things will get pretty exciting at that point. So the extent to which they can maintain these rises, I don't know. So my answer is, yeah, short term, I don't think it's terrific. Long term, actually, it's exactly what we want, because it's exactly what we predicted. And we want to be in the scarce assets while this whole thing plays out.
Question from Roger, a very common question we get. What are your thoughts on NFTs?
Yeah, well, I think there's some very specific use cases which I believe NFTs will do very well. The one that we're most interested in a fund is inside video games. I think people will spend a lot of money in video games. That, you know, they spend hundreds of billions already buying swords, weapons, whatever it is, football boots in FIFA games. There's going to be a lot of money spent on those things, particularly when the user feels they can own it and resell it. Now, video game development takes a long time. It takes 5 to 7 years. So they've only really had 12 months to think about NFTs. So it's going to be a long, long time before we see these assets truly embedded in the games, in high quality games. But I think it's going to be an enormous market. I think there's lots of NFTs out there that are probably, again, the majority right now are probably worthless. But that doesn't matter too much to me because we're in the protocol layer that benefits whether they go up or down, right? So specific NFTs, you should make your own assessment. I'd rather that we're in the protocol layer. I do believe there's going to be an enormous market for this stuff as we go forward. But the things that are out there now, well, I think it's very much a road test and only for the brave as far as specific NFTs go.
Sure. And we've got a sort of related follow-up question from Ishan. What is the fund's allocation to Web3? So you mentioned we've got a bit of exposure to the protocol layer. What's the overall allocation to both the protocol layer and the individual assets? Yeah,
it's just slightly over 10% if you include the protocol layers. So, but actually specific NFT type metaverse stuff is probably less than, it's probably around 1%, might be just under 1%. So it's very small. And I think we probably won't open our shoulders too much on that until we find assets that we really, really believe in. So the thing that makes me really, really believe in this stuff is when I see the ecosystem that surrounds it look good. So I'll give you an example. If I look at cryptocurrency exchanges like Binance, what they've built over 3 or 4 years is absolutely amazing. The speed at which they release product. They basically built the New York Stock Exchange in 12 months. I mean, their product's miles better than anything else out there. And so their token has this ecosystem to exist in, and it has this whole economic imperative to it. When I see that in a video game, that's a high quality video game, and they're either selling cars or fashion items or whatever it might be in a game, I think at that point we'll really start to move into whatever the protocol layer is that supports that game. So I really do like that gaming sector. I follow it closely, and I think that will be the point at which we start to open our shoulders very much into metaverse and Web3.
A few Bitcoin related questions. I assume this one's related to Bitcoin. Raymond says, are there any other competitors for the store of value use case?
Well, I don't think so in the digital asset class. So, and I think the proof of that in many ways is most assets are moving away from proof of work to proof of stake. I think the value proposition for Bitcoin sits on top of that proof of work. It's an energy-backed ecosystem. Most others are moving away from that. And I don't think that we're seeing anybody even try and challenge Bitcoin as far as store of value is concerned. The store of value comes not only from that sort of energy backing, but also from the network effect, which is enormous. You got to remember with Bitcoin, there was never any marketing. It's naturally arisen to where it is, right? So there was never any sort of seed round or issuance to a group of developers. It just naturally arose from day one, and replicating that is just enormously difficult when you consider the scale that Bitcoin's now at. If you look at, it's the single largest computing network in the world by an order of magnitude, and I just can't perceive that overcoming that is going to be something that anyone's going to be able to do. And more than that, people have tried. They've been trying for 10 years and they haven't managed it. And so, no, I think Bitcoin's the winner when it comes to store of value.
Chris has asked, will the ETFs using derivatives affect the price of Bitcoin?
Yeah, it's interesting. I think at the moment you're seeing a lot more activity in derivative markets than you are actually in the spot market. But ultimately, the the question seems to me like, are we going to get this same sort of manipulation that we get with gold, and the gold market sort of being squeezed downward by the derivatives market? The difference with Bitcoin is that there's no cost to take delivery of Bitcoin. If you buy $1 billion of gold, you almost never want to take delivery of that, because it weighs too much, and your safe's going to collapse. So you almost always close the futures contract before you have to take delivery. In Bitcoin, no one's got any problem taking delivery because there's no cost to delivery. So I don't think the futures market's going to play out in the same way that gold did. I think it will there's going to be a tremendous short squeeze in Bitcoin at some point, which will sort of teach the futures market a different lesson about Bitcoin from the one they learned about gold. So no, I don't. I certainly think futures are starting to dominate at the moment, but I think in the end, you just won't be able to keep a lid on spot given the amount of money that's sat on the sidelines. So yeah, trade short futures at your peril, I would say.
There's another good one here from Chris again. Do you think that when millennials come of age, they will keep the same investment strategy? Isn't it likely they will move to a more conservative approach? So you mentioned in the preso, millennials, 6 times more likely to invest in digital assets. Will they be the same when they have a bit more wealth behind them?
Yeah, I understand. I think what you're going to find is the millennials are going to mature, and they might go, well, I'm going to just change the sort of my risk allocation, but also this whole sector is going to mature, right? So Bitcoin in 10 years is going to be considered, I think, a reasonably boring asset that everyone's got some allocation to. Similarly for the whole sector, I think everyone will have some allocation to this sector. It won't have the volatility that we see now. So by the time they've got their hands on that $30 trillion of assets, being in this sector will be considered normal and conservative. So I don't actually think they're going to change. And certainly as we get there, are people going to allocate to the bond market, for example, in 10 years' time? When you look at what's happening in the bond market and the amount of issuance you're going to get in that market, and the amount of bonds that are come on the market from retiring cohorts, the other asset classes just don't look that attractive. I think this will look like the place to be, and will actually be sort of, I wouldn't say boring, but it will certainly be much more mature than it is now.
Great. One more question before we get into a few of the fund-related questions. Thomas has asked, do you see DeFi yields as being sustainable at current levels? Might be worth giving a bit of background on the DeFi yields.
Yeah, okay. So just on DeFi yields to start with, how that works. If you own a, say, for example, a stable coin, $1,000 of a US dollar stable coin, you can post that into a software protocol in DeFi and earn, say, 10% interest. Now, sometimes that interest is paid in the stable coin. Sometimes that interest is paid in the asset of the DeFi protocol that you're using. Now, to me, probably 90% of the sort of lending that's going on in DeFi at the moment is a merry-go-round between people in the ecosystem, and only 10% of it is for real economic reasons. But there are genuine protocols out there where you can sensibly lend and borrow money using crypto assets. So, for example, with Bitcoin, you can borrow against Bitcoin for 1% at the moment, which is remarkable. That interest rates come down all the time. I think there are instances where it very much is real. I think the sustainability of the high interest rates, so where you're getting paid sort of the 20 and 30%, no, I don't think that is sustainable. I think that's an attempt by those DeFi protocols just to build critical mass, which they're paying for with their own money. And so that money's going to run out, and that yield is not sustainable. Because the reality of it is, the market's going to coalesce around an interest rate that is the interest rate, right? So, and it isn't going to be 20% as some of these protocols pay. So, no, they're not sustainable. But yes, there are credible borrowing and lending platforms that offer much more sensible rates and much more sensible levels of collateral.
A question from Dan. Does the fund have a trustee / custodian?
We certainly have a custodian, so we use Gemini as the custodian. So they're based out in New York. Winklevoss brothers, they've done a tremendous job with their custody. We've done a lot of due diligence around it, so we're extremely happy with them. ListedReserve is the trustee, so we've got our own AFSL. So yeah, at the moment they're not separate now.
Excellent. And we might just find one more question to finish us off. Question from Brett. If 90% of Bitcoin has been mined, what incentive is there for new miners to enter? Is there a risk to Bitcoin if mining services become less appealing?
Yeah, so mining rewards will, we're actually in the second half of this halving, so mining rewards are going to drop in 2 years' time from now. So at the moment, there's 900 Bitcoins a day issued to miners, and that's going to drop to 450 Bitcoins a day in 2 years' time. Actually, it's not so much the number of Bitcoins that are issued to the miners that they care about, it's the value of the Bitcoins that are issued. So if you look at the income earned by the Bitcoin miners over time, it's only ever gone up. Now, there are certainly times, so when you see those 40% declines I shared with you on this chart, they have difficult times when that happens. But no, I don't think it's going to be an issue because the price has risen to compensate the miners for their efforts. And when the price falls, Bitcoin's mining difficulty generally also falls. So the amount of money they need to spend to mine the coins also falls. And if you want to read more about it, actually the Bitcoin difficulty adjustment is probably one of the most amazing things about Bitcoin, is the way that when the market turns and the price falls a little bit, the protocol makes it easier for miners to sort of maintain that 10-minute window of blocks. Just on that point, we also get questions about, well, that's all fine, but what happens in 2140 when there are no more Bitcoins to mine? And the answer to that is miners earn not just the Bitcoin, they also earn the fees that people pay per block. Now, if you look at the fees, the average fees per block at the moment, it's probably 5% of the reward is paid in fees. But as Bitcoin grows and more and more and more people use it, that fee market grows and grows and grows. So you can see, I expect in 5 years that we're going to be somewhere up to 10 to 20% of the reward paid to miners will be fees and not reward. And you'll start to see the ratio of fees to reward get bigger and bigger and bigger over time. So when you get to 2140, I'm not personally going to get there, but that mix is going to be dominated by fee, and there'll still be an incentive to mine Bitcoin because you will continue to earn the fees. So, and interestingly, this all was sort of played out in the sort of early days of Bitcoin, when he was explaining how he'd done it and how he was thinking about it for 100 years' time. So, no, I definitely think the incentive will be there. I still think we're going to have instances where Bitcoin miners go bust. It's happened ever since day one. I think it'll happen again because of the amount of hash that's currently entering the system. It's supremely competitive, Bitcoin mining, and really risky. Yeah, the protocol's designed to adjust to make sure that they're, over time, the best miners are properly rewarded. And I think that will continue for a very long time.
Excellent. We're coming up to 40 minutes now, so I think that's a good place to leave it. Thanks everyone for joining today, and thanks Dan for your time. If you have more questions about the fund, just jump onto our website, ListedReserve.com. There's a contact page there where you can fill in and book a call with myself or Dan. And we can also fill in the fund application form online now. So if you just go to the top of the website, click the invest button, you can see the full application process, all digital now. So yeah, thanks Dan.
Thanks a lot everyone. Thanks for joining.